All right, let's get started. It is 12:30 Pacific time, and I want to make sure we get started on time. This is being recorded. It's because it's by far one of my favorite webinars. This is our 2023 Mid-Year Market Outlook. For those of you that are not familiar, we do these once in the beginning of the year and then in the mid-year to kind of talk about what we think the rest of the year is going to look like from a market outlook, from the economy, international economy. How is it all going to come together and affect investment? All right. So as always, just a quick disclaimer that this presentation is for information purposes only. I know we talk a lot about ideas here, but if you need specific advice, whether it's investment, tax, or legal, or other financial assistance, please make sure you seek the person that invited you to this webinar, and they'll be happy to answer any questions. We do a lot of these online workshops on building a defensive portfolio, financial planning, structured income, social security, estate planning. So again, this is the mid-year market outlook, but there's tons of other educational webinars that we do at Protection Point Advisors. Today, we're going to cover 2023 so far, and what have we experienced and what should we be looking for, market and recession concerns, which is on top of everybody's minds. We're going to talk a bit about interest rates, inflation, and of course, investment opportunities inside of everything that we're hearing about in the market. So real quick about Protection Point Advisors, we have a couple of offices in Los Angeles, California, and Roseville, California. The firm was started in 2008, but the history goes back further than that. We're a specialty investment group with financial advisors, CFP, CLUs, and a very experienced support staff. And I can't emphasize this point enough. We have a dedicated financial planning team that helps our clients achieve their dreams. As always, just a quick shout out to the amazing staff that makes everything happen behind the scenes. And of course, our partners throughout the country in the National Referral Network that make our 3D asset care happen when it comes to our clients. So this slide should be familiar with everyone. This is the elements of financial success. Everybody needs investment management, but financial planning, retirement planning, estate planning, tax, financial literacy, college planning, and everything else that you see here is a very important part, but the most important part is making sure that all the elements are working together to create what we call total asset protection. So again, to ask questions, I want you to make sure that you click on that question box and send in any questions that you may have. So I just want to quickly mention where our outlook comes from. First of all, we have relationships with top institutions. There's 100 years of combined analysis and investment experience here at Protection Point Advisors. And I can't think of anyone better than Rick Watson, who's the founder of Protection Point Advisors, to talk to us a bit about that experience. Rick, are you there?
I am. Thank you, Patrick. And yeah, a little bit about me. I've been in this business for 35 years or so. Followed my dad with 40 years before that. Our firm is built around this idea of having a great experience, a great place for advisors. There's just so much in the industry that we would prefer to change, that we built a better solution ourselves. Before we talk about where we're going, I think it might be really helpful to give you some context of where we've been. And I'm going to start with a stock chart. And I get that this could be a little confusing. I'm going to explain it. So basically, every little green or red line is a week in the market, okay? And the green ones are up weeks, and the red ones are down weeks, how much it moved in that period. And what we're looking at, by the way, is the S&P. What we see is 2021 to 2023 and the movement in the market. And what I want to point out is a couple of things here, okay? First of all, coming out of COVID, we had a really nice positive growth pattern, okay? It was nice and clean. The momentum was behind us. And then we got to 2022, and the market changed dramatically, and we ended up in a negative pattern. And we're in a downtrend, and you can see right here, we shifted from being in a downtrend to being in an uptrend. So even though the market had come up from the bottom, it was still in a downtrend until it crossed that red line. Now, starting over again, I want to just point out here that, in those period coming out of COVID, it was pretty volatile, but looking backwards, it was a fairly narrow range. But what we've got since then, 2022, was a massive range, and that volatility has just dramatically increased. Now, again, back to this downtrending market. What it appears, though, since we've passed out of that downtrending market, it appears that we're in a range-bound market, which is a sideways market, just bouncing along sideways. Okay, and one might argue we're actually in a fairly narrow range. Right now, you can see that we're right at the top of that market, but it would not surprise me if we hit the top of that line and worked our way back down to the bottom again. What we're forecasting is a mild recession, likely in the third quarter. Mike and I had a conversation about this because, is it June, is it July, or is it September? But again, sometime in third quarter, late third quarter, I think would be one way we're looking at this. We would expect most recessions last 3 to 6 months, and the odds of a recession for us right now is about 75%. Now, before you get scared, recessions are part of the natural universe. We would expect them coming in and out. It allows markets to reset, so not to be too concerned about it. It might create some buying opportunities, particularly in the late recession, and we want to prepare you for what likely is going to happen. Now, the reason we'll see buying opportunities is because the market starts to see the light at the end of the tunnel. And Mike's going to talk about this later, but there's a period where the market, the economy might be heading down and the stock market might be heading up, and it shouldn't surprise any of us. Okay, so we'll talk a little bit about that coming up later. So again, portfolios sitting in cash could benefit. We have a lot of our portfolios in cash. We'll get to that as well coming up here. So our year-end prediction right now is for the market to end the year somewhere between 3,900 and 4,400. If you think about that, 4,400, that places us roughly at about 10% over where we're at today. And we would expect this market might continue sideways and then sort of take off at the end. We're going to show you that downstroke coming up here in a bit. So probably a strong fourth quarter for stocks and a late recession bounce. And we'll talk about why that is coming up. Interest rates are going to start to drop, and then labor shortages will start to ease up. That puts less pressure on inflation and allows stocks a little bit more room to go. Now, what we should also expect is that bonds may improve before stocks. At least historically, that's what happens. Now, the thing is that bonds should experience a limited bond recovery. Let me explain what I mean by that. See, bonds are highly dependent on interest rates. What happens is when interest rates go down, bonds go up. So we've had a period where interest rates have gone up dramatically, and that's really hurt bonds. But we expect interest rates to come down, and we show that right here. But you see the Fed interest rates. This goes all the way back to 2000, and the Fed increases interest rates, then drops them back down, and then increases interest rates and drops them back down. But we get here to the most recent period, they've increased them up a bunch, and you see that little projections there at the end, the implied interest rates of where they think things are going, that orange and sort of gold. But you can see that they're not coming back down to that base area. And so it doesn't allow bonds to completely recover. We think interest rates are going to remain high. And this is a little example of that. The first cut may be in November. So this is a chart of options data. So every time someone places a bet, whether the interest rates are going to go up or they're going to go down or where interest rates are going to be in 6 months, that is basically an options contract. And if you can add up all those contracts, you basically can see that currently we're at about 5%, and we would Fed rate. And by June, there's a 67.9% chance we're going to stay there. And July, 56.7%, so on. You can see the first change, the first drop in interest rates happens in November. And I've done that in yellow for you. So the idea is these numbers change constantly. We were looking at these numbers a week ago, and it showed an interest rate increase. Now that's gone away. So at present, this is a snapshot as of a day or so ago. With that, I want to introduce my partner. He's been my partner for a long time. Mike is an amazing advisor, deals with a lot of our compliance and a lot of training for our advisors. With that, I'm going to introduce you to Mike Clark. Mike?
Thanks very much, Rick. I'll do my best to live up to that introduction. So obviously there's been a lot of talk about an impending recession. And I want to first mention there's actually two definitions of what a recession actually is. The first is the textbook definition. If you take an economics class, chances are you're going to get the definition of a recession being 2 quarters of negative GDP growth. GDP growth is actually underwater for 2 quarters. Then there is the National Bureau of Economic Research definition, which defines a recession as 2 consecutive quarters of receding economic growth. So by the latter definition, we've actually been in a recession rather for about the past year. But again, as Rick was pointing out, recessions are not anything to be feared. They're part of the economic cycle. Economies expand, they peak, they recede, and then they bottom out or trough. The question we get a lot is, well, will the markets follow the same track? And oftentimes, no. As a matter of fact, markets typically begin to recover about halfway through a recession if history is any indicator. And the reason for that is markets are forward-looking. Markets look out 6 months, a year in advance and make their trading decisions based on what they think will be true then, not on what's true now. And this is about where we are now. We are about, we think at least, near the bottom or near the bottom of the second economic activity, which is why we feel somewhat comfortable saying we think this market is on the precipice of finding its feet and perhaps turning around. And let's look at returns across different asset classes in the early part of a recession. You can see here that it's just not good for small caps, small cap growth, small cap value, large cap growth. I mean, the numbers are just not good in the early stages of a recession. And I think we've seen a great deal of that over the past 15, 18 months. However, late in a recession, the opposite becomes true. You can see that small cap growth leads the way overwhelmingly, followed by small cap value, large cap growth, and large cap value. You can see that stocks tend to really spring back up in the late stages of recession. It was especially true during the Great Recession of 2008, 2009. So let's talk about inflation. Inflation, however, is still being rather stubborn. This chart examines some of the year-over-year inflation across different things. We all buy eggs, for example, are up 36%. Airfare is up 17% in addition to what it was up year over year. So if you want to go somewhere, you're going to pay a little bit more to get there. Electricity is up 10.2%. Rent's up 8.8%. Food and beverage is up 7.5%. Oddly enough, computers and smart home devices are down 5%, and gas is down 12%. Of course, gas had nowhere to go but down over the last year. But inflation is still being rather stubborn. And there are 2 main factors that are driving inflation. First, the money supply. The Fed printed more money than it ever had. It introduced more currency into the system than it ever had at any time in history during the pandemic. And also, labor is expensive. If you know anybody who has a business, chances are you know somebody who's looking for help. And help is really hard to find, in part because so many people left the workforce during the pandemic. And those that left their jobs often left for or waited on the sidelines for better opportunities. So labor is in fact more expensive. It's kind of a seller's market where labor is concerned. And this is a chart that examines the money supply. You can see here on the right, the blue line here, you can see where the money supply peaked in 2020, early 2021. And again, they introduced more money than at any time in history. And since then, they've been taking money out of the economy probably faster than at any other time in history as well. So think of driving your car down the road at 100 miles an hour and then slamming on the brakes. That's really basically what's been happening regarding the money supply. And of course, driving inflation is labor. It's hard to envision a really hard recession when labor is when the unemployment rate is 3.5%. There's an acute labor shortage out there, and every employer that I know, for example, who's looking for help is willing to pay more money for it. It seems like everybody has to do that. Let's talk about real estate. So real estate, the prices are still remaining somewhat stubborn. It of course varies by region. It's almost zip code specific, but the fact is we haven't built enough houses for the last 15 years. And interest rates have increased, yet prices have remained high, and that has put some strain on the real estate market. Commercial real estate is also feeling the pinch. High interest rates have made it difficult for the holders of commercial real estate, for the holders of commercial paper to refinance. Unlike residential real estate, commercial real estate tends to get refinanced at 5-year intervals. That's not welcome news. It's going to put strain on that particular economic sector. And also, it's important to also note that a good percentage of the workforce just didn't go back to working in offices at all. The work and home culture is with us, and it's here to stay. And it has in fact put some strain on commercial office space, especially. So with that, I want to hand it back over to Rick, who's been my partner for as longer than I can remember, to talk about some of our solutions and how we're responding to a lot of what's going on. Rick, I want to hand it back to you. Are you with us?
I am. In all that experience that we've had, this real estate market the commercial market and its struggles are going to be a unique situation. I think that every time I turn around, it seems like, again, something unique's coming around the corner. So anyway, so I'm going to talk a little bit about where should you invest, okay, or where could you invest. And in a period with high volatility, yield, that's interest and dividends, is going to be the king. And right now, we're going to see returns in high yielding investments at higher returns than we're seeing that we would expect out of stocks over time. And I just think that's interesting. The three areas that we're talking about, structured income, real estate, and high dividends, all of those things are that, really great places to be during periods of high volatility. And I just want to take a moment and talk a little bit about structured income, because that's sort of stuff that people don't necessarily know what it is. So structured income. First of all, we have a whole webinar on this. If you don't know about structured income, you'd like to know more, just write in your notes. Please send me, in your question box, please send me structured income webinar, and we'll send you a recording on this, because I'm not going to have the time to go through all of it. But basically, it's asset-backed debt or real estate. So basically, somebody borrowed money and they gave you collateral, right? And real estate. Typically, what we're looking for there is a yield somewhere between 5 and 9% with expected stability. So when we talk about structured income, we want it to be sort of steady Eddie. It doesn't mean it's always steady Eddie, but it's mostly steady Eddie. I just want to give you some examples, and I took off the names of things because I don't want to have to give you all prospectuses on every single thing that I'm going to talk about here. But just to give you an example of what's possible on the structured income side, bridge debt at 8%, senior floating CLOs we've got right now are paying 11.5. And these are not scary things. These are really basic, simple, we could do this easy. So if you're thinking, hey, should I put money into that CD? I'm going to say, yeah, because CD rates are up, but these things are significantly higher. So all rates came up. And this kind of corresponds to this idea of the cycle of emotions when people do their investments. So, we start with this thing of emotions, right? You start with optimism, then excitement, euphoria, anxiety, depression, panic, skepticism, maybe it's getting better, back to optimism. As long as we've been doing this, we continue to see this same flow that happens all the time. Now, here's the problem. Clients always want to buy here, and they always want to sell here. And logically, this would be the best time to sell, and this would be the best time to buy. So emotions are a really poor gauge, is never a recipe for success, right? And with that, I'm going to show you one other example of this, and then we're going to get into some more solutions. So I just thought this was an interesting chart, and I was trying to figure out where to put this in here. 5% losses in the market happen typically about 3 times a year. Average length of time that you're down is 39 days, and the last occurrence was this March, so relatively recently. 10% losses, they happen every 16 months or so, and they're down for about 129 days, and the last one was in October of 22. So far, that makes perfect sense. What I want to show you is this. 15% losses every 3 years, 230 days to come back, October 2022. Same day. Oh, losses of 20% or more every 5.3 years, 335 days, and so on. You can see that we just experienced a significant event, and we shouldn't be too hard on the portfolios because, look, if you can keep your head when everybody else is losing theirs, we're in a pretty good place. And so for that reason, one of our solutions is that we use layers and systems. And I'm going to get into some of our portfolios and how they're allocated, which might help as well. But we use these layers and systems as a way of avoiding emotions making decisions. So we want to decide in advance what we're going to do, how much risk to take, and how the portfolios should defend before we get there. So what are layers? They're multiple investment approaches, all in one account, diversifying your investment approach to enhance efficiency. And an example of that, you might have a layer of buy and hold. There's nothing wrong with that. It goes up with markets. It comes down with markets. It just is. Momentum tries to get out of the way of markets, right? It's like a speedboat. The other one's more like a trawler. You get dividends. I always call that a milk cow, so I'm mixing my metaphors here. And you might have a layer of alternatives, and alternatives really bailed clients' portfolios out over the last 2 years. And then we surround this all with these protection point fuses, points where the portfolios pop and say, hey, we're moving this portion to cash. You're going to see that how in a minute. And I just already mentioned structured income, so we might as well throw that into it, all customized to you. So with that, I'm going to pass this back over to Patrick. He's going to talk a little bit about his 3D Asset Care program.
So I just want to talk a little bit about our 3D Asset Care program, because everything Rick talked about are the mechanics of investing, but the truth is investing goes a lot further than just obviously investing in the market, as we just talked about, and that comes with education through our 3D Asset Care. In other words, we bring professionals such as CPAs, tax attorneys, financial planners, estate planning attorneys, college planners, and anything else that touches clients' money in our webinars. These are typically run once a month, and the beautiful part about them is afterwards we talk about the portfolio. So Rick and Mike, the founders of the company, are there to discuss portfolios. We also bring people through the national referral networks of vetted professionals to be able to help our clients understand more about what they need in order to create total asset protection. And you can always ask questions live. So I'm going to wrap it up today, and I want to thank everyone for attending. Again, I highly encourage you to attend tomorrow's extended webinar with Rick and Mike, the founders of Protection Point Advisors.